Hello and welcome to session 37 of Direct Tax 2, 4th semester BCom of Mangalore University. Now in this particular session, we are going to learn exemptions under section 54. We are going to learn two exemptions, that is under section 54 EC and section 54 F. So let's understand what is this section 54 EC and what is it related to. Long-term capital gains exempt under section 54 EC, that is transfer of land and building invested in long-term specified asset. So long-term capital gain exempt under section 54 EC, that is we are transferring land and building and we are investing in long-term capital asset. What are the rules as far as this exemption is concerned? The long-term capital gain arising on the sale of land or building or both will be exempt from tax under section 54 EC subject to the following conditions. What are the conditions? SSE should purchase the specified bonds, that is redeemable after 5 years, either issued by NABARD, that is National Bank for Agriculture and Rural Development, National Highway Authorities of India, NHAI, REC Limited, that is Rural Electrification Corporation Limited, Power Finance Corporation Limited, and Indian Railway Finance Corporation Limited, that is within 6 months after the date of sale of the original land and buildings. That is from the date of transfer of that original land or building, the SSE must purchase specified bonds of these institutions. Now, as far as exemption 54 EC is concerned, the timing of issue of such bonds is also a matter, because only when such institutions issue bonds at the time when the SSE is transferring his property, SSE can claim exemption under 54 EC, and maximum amount that he can claim is 50 lakh rupees. So 50 lakh rupees is the amount specified bonds, worth specified bond the SSE can purchase. Now, what is the exemption limit? The capital gains used for the purchasing the specified bonds will be exempt under section 54 EC. Now, very, very important point. In other exemptions under section 54, 54B, 54D, we could have utilized the capital gain account scheme. That is for the time being, unless we find a good property, unless we find a good agricultural land, or for that matter another piece of land or building for industrial undertaking. But section 54 EC, the SSE cannot claim the benefit of capital gain account scheme. So deposit of capital gain in CGAS is not considered for the exemption under section 54 EC. Next is the withdrawal of exemption. New bonds purchased cannot be transferred within 3 years from the date of purchase. This is a very, very important rule. And if it is transferred, then the exemption of capital gain enjoyed earlier will be treated as long-term capital gain. So when the original asset was sold, the exemption that was enjoyed, that will be withdrawn and it will be treated as long-term capital gain. Let's move to the next section, that is section 54F. Capital gain arising on the transfer of any long-term capital asset, that is land or any commercial property. We are not talking about residential property. So transfer of any long-term capital asset, land or a commercial property other than a residential house, an investment of the consideration in a residential house, meaning to say you are selling a commercial property, you are selling your jewelry, or you are selling any long-term capital asset other than a residential property and investing the amount by purchasing or constructing a residential house. Now that is covered under section 54F. This is a very, very important and a very interesting section. Long-term capital gain invested in a residential house by transferring any long-term capital asset other than residential house is exempt from tax subject to the following conditions. What are the conditions? The SSE, either individual or HUF, must transfer any long-term capital asset other than a residential house. That means section 54F exemption is available only to an individual or HUF. transfer of any long-term capital asset other than a residential house. The SSE must purchase a new house that is within 1 year before transfer or within 2 years after transfer of a long-term capital asset. So very, very important point. The SSE can purchase an asset either 1 year before transfer or 2 years after transfer, or must construct a new house within 3 years after transfer of that long-term capital asset. Very important rule. SSE must not own more than one residential house on the date of transfer of that long-term capital asset, other than as mentioned in point B, that is purchase of a new house within 1 year before transfer. So here the SSE will have two houses, and because that that first house is sold, there is another house because it was purchased within 1 year before the date of transfer of this particular house. So other than as mentioned in point B, more so related to that house purchased 1 year before transfer, SSE cannot own more than one residential house. So that 1 year before transfer purchase house itself is the exemption that SSE can claim under 54F. So the SSE must not own more than one residential house. Also, the SSE must not purchase another house within a period of 2 years after the date of transfer of that asset, long-term capital asset, or construct within a period of 3 years after the transfer of such asset. So there is an extra condition. SSE cannot purchase another house within 2 years from the date of transfer of the long-term capital asset. He cannot construct another house within a period of 3 years from the transfer of such asset. Because if we go to point C, SSE should not own more than one house when the asset is transferred. Also, from the date of transfer within 2 years, no purchase of second house. Also, from the date of transfer to 3 years, no construction of any other house. So there is another extra condition that the SSE has to follow here. Now, what is the exemption limit? If the cost of the new house is more than the net consideration, this is very important. First time we are coming across the concept of net consideration. So if the cost of the new house is more than the net consideration is nothing but sale consideration of long-term capital asset minus the selling expenses. So sale consideration minus the selling expenses is the net sale consideration. So if the cost of the new house is more than the net sale consideration, entire capital gain amount is exempt from tax. That is, net consideration unutilized for the time being can be deposited in CGAS either on or before the due date, just to postpone the taxability of that particular gain. But if the cost of the new house is less than the net sale consideration, for example, if the cost of the new house, let's say, is 18 lakh, and the net sale consideration is, say, 20 lakh minus 50,000, let's say 19 lakh 50,000. So if the cost of the new house is 18 lakh and the net sale consideration is 19 lakh 50,000, then proportionate capital gain exemption will be available to the SSE. How do you calculate proportionate capital gain exemption? We take amount of consideration utilized, that is a cost of the new house, that is 18 lakh, into capital gain. We'll have to find out how much is capital gain, divided by the net sale consideration received, that is divided by 19 lakh 50,000. That means to say we are going to get an exemption which will be lesser than 18 lakh, because it will be cost of consideration utilized is nothing but the amount, the cost of the new house purchased or constructed into capital gain divided by net sale consideration. Now, what are the rules for withdrawal of exemption? The new house purchased or constructed cannot be transferred within 3 years from the date of purchase or construction. It cannot be transferred within 3 years. If transferred, then the exemption of capital gain enjoyed earlier will be withdrawn and will be treated as long-term capital gain. Remember, original asset transferred is only a long-term capital asset other than a residential house. So if this new house purchased or constructed is transferred within 3 years, then the exemption given earlier will be withdrawn and will be taxable as long-term capital gain in the previous year in which the new house is transferred. Also, if the amount continues to remain in capital gain account scheme, then such amount will also be treated as long-term capital gain. And if the SSC purchases another house, remember there was another rule. If the SSC purchases another house that is within 2 years of the transfer of original asset or constructs a new house within 3 years from the transfer of that original asset, then exempted capital gain of earlier will be taxable, will be withdrawn, and it will be taxable as long-term capital gain. So also capital gain amount account scheme balance, if it remains unutilized, it will be treated as long-term capital gain in the previous year when such specified period expires. So under section 54F, we talk about proportionate capital gain exemption. So when I'm saying proportionate capital gain exemption, I am talking about full utilization of long-term capital gain. That is, if the cost of the new house is more than the net sale consideration, that is sale consideration minus selling expenses, entire capital gain will be exempt from tax. But if the cost of the new house is less than the net sale consideration, then only proportionate capital gain exemption is available. So that's all in this session. We will be solving problem on section 54F in the second part of this particular session. Thank you.